Some people say dividend investing is the best strategy in the world because you get paid while you sleep. Others say dividends are completely useless, and that growth stocks will always make you richer. So who's actually right? Well, the truth is, most people completely misunderstand what dividend stocks and growth stocks actually are. And more importantly, most people choose the wrong strategy because they copy investors who are in a completely different phase of life. A 22-year-old investor should not invest the same way as someone close to retirement. And someone who panics during market crashes probably shouldn't build a portfolio that drops 70%. So in this video, I'll explain what dividend stocks really are, what growth stocks actually do, why psychology matters more than most people think, the massive tax difference most European investors ignore, and finally, which strategy I genuinely think makes the most sense depending on your age, personality, and goals. Let's start simple. Dividend stocks are usually large, mature companies that already dominate their industries. Instead of reinvesting every euro back into aggressive expansion, they distribute part of their profits directly to shareholders. That payment is called a dividend. So if you own shares of a company like Coca-Cola, McDonald's, or Johnson & Johnson, the company may send you cash every few months simply for holding the stock. And this is exactly why many investors love dividend investing, because it creates the feeling of getting paid while doing nothing. Now, obviously, dividends are not free money. When a company distributes cash, the stock price usually adjusts downward by roughly the same amount. But the important difference is this. With dividend companies, you decide what happens with the cash. You can reinvest it, spend it, or allocate it somewhere else. And over time, if you consistently reinvest those dividends, you create a compounding snowball effect that can become extremely powerful. This is why some investors become obsessed with building passive income over time. Growth stocks work very differently. These are companies focused on expanding as aggressively as possible. Instead of paying investors today, they reinvest almost every dollar back into the business. New products, artificial intelligence, research, expansion, market domination. That's why companies like Amazon, Tesla, or Nvidia became so explosive over the last decade. The goal is simple: sacrifice income today for potentially massive growth tomorrow. And historically, this strategy has created enormous wealth. Someone who invested in Amazon many years ago achieved returns that completely destroyed the market averages. But there's a catch. Growth stocks are usually much more volatile. Some of them can fall 40%, 50%, or even 70% during bear markets. And most people think they can emotionally handle that, which until it actually happens. This is the part most finance channels completely ignore. Investing is not just mathematics, it's emotional endurance. Growth investing has massively outperformed dividend investing during the last decade, especially because technology stocks exploded during a period of extremely low interest rates. But here's the problem. A strategy only works if you can emotionally survive it. A lot of people say, "I'll hold forever." But when their portfolio suddenly drops 40%, they panic. They stop investing, they sell at the bottom, or they completely lose confidence. And honestly, this is where dividend investing becomes extremely powerful. Because even when markets crash, you still see cash entering your account. That creates emotional stability. It makes investors calmer, more disciplined, and less reactive during bad periods. For many people, that psychological advantage is worth more than maximizing every possible percentage of return. Because the best portfolio in theory means nothing if you abandon it during the first crash. Now here's something extremely important if you live in Europe. Most American finance channels completely ignore this part: taxes. Because in Europe, an accumulating ETF can behave very differently from direct dividend investing. For example, if you buy Coca-Cola shares directly, you receive dividends in cash and usually pay taxes every single year. But if you buy an accumulating ETF that contains Coca-Cola, the ETF automatically reinvests the dividends internally. You never actually receive the cash directly. Which means in many European countries, you delay taxation and allow compounding to work more efficiently over time. And this is one of the biggest reasons why many long-term European investors prefer accumulating ETFs, especially when they are young and still focused on growing wealth rather than generating income. Historically, just like I said before, growth investing usually generated higher total returns, especially during the last 10 to 15 years. Technology companies completely dominated the market, but this does not automatically mean growth will always win forever. because different market environments favor different strategies. During recessions and market crashes, dividend companies tend to be far more resilient. They usually fall less, generate stable cash flow, and create a much smoother investing experience. So the real answer is not which strategy is objectively better. The real question is, what type of investor are you? Because growth investing usually maximizes wealth faster, while dividend investing usually maximizes stability and passive income. And depending on your personality, one of those strategies may help you stay invested for much longer. One of the biggest mistakes beginners make is choosing investments based only on excitement. A lot of people buy growth stocks after they already exploded. They see companies like Nvidia, Tesla, or Amazon going up hundreds of percent and assume the growth will continue forever. But then the first big market crash happens and suddenly they realize they were never emotionally prepared for that level of volatility. But dividend investors also make mistakes. Many beginners become obsessed with extremely high dividend yields, without understanding that sometimes a 10% or 15% dividend yield is actually a warning sign. Because if a company pays an unsustainable dividend, that dividend can eventually get cut. And when that happens, the stock price often crashes as well. Another massive mistake is thinking you must choose only one side. You do not need to become the dividend investor or the growth investor. Many of the best investors combine both strategies depending on their age, financial goals, and risk tolerance. And honestly, one of the biggest traps in investing is something called recency bias. People assume whatever performed best recently will continue forever. Technology stocks dominated the last decade. So now many investors automatically believe growth investing will always win. But markets move in cycles. Different environments favor different strategies. Because investing is not about joining a tribe online. It's about building a portfolio you can realistically hold for decades. The truth is, the best investment strategy changes completely depending on your phase of life. If you're in your 20s, your biggest advantage is not money, it's time. You have decades ahead of you, which means you can survive volatility, market crashes, and temporary mistakes. That's why younger investors usually benefit more from growth-focused investing, because time allows compounding to become almost unfair. But later in life, your priorities start changing. When you're approaching your 40s or 50s, you usually care less about maximizing every possible percentage of return, and more about stability, predictability, and protecting what you already built, and eventually, close to retirement. Cash flow becomes much more important than aggressive growth. At that stage, dividend investing becomes extremely powerful, because instead of selling your investments during market crashes, your portfolio can start paying you directly, and psychologically that changes everything. Personally, if I was starting from zero in my 20s living in Europe, I would probably focus mostly on broad accumulating ETFs, long-term growth, and aggressive compounding. Because at that age, your biggest goal should probably be accumulation, not passive income. But that does not mean dividend investing is bad. Actually, I think many investors underestimate how valuable stability and cash flow can become over time. And honestly, you don't even need to fully choose one side. Many smart investors combine both strategies. Because investing is not about joining a tribe online. It's about building a system you can follow consistently for decades. If there's one thing I want you to remember from this video, it's this. The best investment strategy is not the one with the highest theoretical return. It's the one you can stick to for 20 years without quitting. Because consistency beats excitement almost every single time. Don't forget to subscribe if you want to keep learning how to invest without hype, without noise, and without making the beginner mistakes most people regret later.